It's tough doing these presentations. Like I sat down in London and thought about speaking to groups like this, and thought I'd put together some really interesting slides on what's important in the world and what's going to drive financial markets. The team and I put a lot of work into that, and this is the culmination of the slides you're going to see now. As the way the world goes, we did all that work and hopped on a plane, and then a lunatic has decided to start a war, and that's obviously what's driving markets right this moment. I think the things that I'm going to talk to you about today are really the underlying drivers that we have to think about for the next few years, and are what is going to reassert themselves as the most important things for investing over the next 18 to 24 months. Obviously, in the near term, what this tragedy that's going on in Ukraine is going to dominate the headlines, but I would suspect that in a few months' time, markets are back to worrying about this sort of stuff. Or, rightly or wrongly, financial markets are there to price assets. They're not there to make a moral judgment on things. And as a general comment, it doesn't feel emotionally right, but financial markets have a terrible tendency of overreacting. If you look at when Saddam Hussein invaded Kuwait, financial markets were back to all-time highs within a few months. Russia is not a very big part of the global economy, and the transmission mechanism of what's going on is really its impact on the commodity markets. But anyway, I'll talk a little bit about war in Ukraine if people are interested, but mainly I'm going to talk about what I think is the most important thing going on in the markets today. And I'll just get my notes. Inflation. It's something we haven't had to worry about for a very long time. I think last time I was here, I was probably talking about why inflation was so low. It was a problem, but something we had to worry about. And in a very short period of time, it's come back onto the radar for everyone. Just to frame the situation, so in the space of just a year, so this time last year, inflation in the US, the biggest economy in the world, running at 1.5%, pretty anodyne. Today, it's running at 8%, a figure no one would have believed you if you told them a year ago. Same in Europe. A year ago, inflation was running at negative inflation rate, something that's really concerning. Today, it's hitting 6%, similar sorts of moves in the UK. Here in Australia, we've had a big pop. It's not quite as extreme as those numbers I've said, but we've gone from less than 1% to more than 3.5% in the space of 12 months. Quite a big move. And I guess the first thing to say is, why do we care? What's the problem with inflation? Well, any of you with some savings in the bank probably care quite a lot. Inflation decreases the value of money. So it decreases the value of our wages or our cash savings, and it increases the value of physical assets like cars, machines, houses, that sort of stuff. Most importantly, at least in my view, inflation, I think, is as much as anything a psychological phenomenon as it is an economic phenomenon. Periods of high inflation have this horrible tendency to become self-reinforcing. When you see the value of your savings or your salary falling, you naturally want to charge more for what you sell or what you work for. And the more of us that do that, the more it becomes self-perpetuating, and what happens is high inflation today starts to mean high inflation tomorrow. And the reverse of that happens. Like if we have long periods of low inflation, which we've had for a long time now, people drop it out of their expectations, and low inflation today starts to mean low inflation tomorrow. So there's this really important psychological cycle that goes on behind the scenes. I'm an economist by trade, so I always start with the economic theory, but the last thing to say about inflation is that economic theory says that a little bit of inflation is good for a system. So that's why central banks target inflation of a couple of percent a year in most grown-up countries. Here the target is 2 to 3%. In the US, in the Eurozone, it's 2% here. So we always want a little bit of inflation, but recently it's kind of gone a bit crazy. You can see here on this chart inflation in the US, the Eurozone and Australia, just three big economies, and obviously Australia is a reference point, up until the start of the pandemic. And what's really interesting, the big debate, I would have been talking about this I think in 2019, the big debate in economics for the last decade has been this concept of secular stagnation. The problem policymakers faced was that inflation was consistently too low. They were worried that inflation was consistently too low. They needed to get it higher. And that was the backdrop for this concept of secular stagnation. You've probably seen the concept bandied about in the press or people like me talking about it. The drivers behind secular stagnation, if we're honest, we don't really know what was going on. A lot of them are to do with big technological changes that we came along, disrupted entire industries, and demographics. Rich world societies getting older, putting pressure on these sorts of things. But it did mean for a long time inflation was dangerously low. And you can see, there we go, The average inflation levels in those three big economies were well below target. In the case of the Eurozone, average inflation for the decade before the pandemic was 1%, so half of what the Eurozone was mandated to try and achieve. While secular stagnation sounds pretty grim, and it's not particularly nice that growth is too low and all the implications from that, it had this wonderful silver lining for investors and for most of us in the room, and that is it let central banks constantly cut interest rates lower. So central banks, their job is to manage inflation. Inflation is not a problem. They can keep cutting interest rates lower and lower and lower to try and boost economic growth, which is great, keeps their job nice and easy. But the challenge we've all faced, or what we would have all seen in the markets, is that interest rates and asset prices move in the opposite direction. It's a bit like a child's seesaw. You push down on one end, the other go up. And we've all seen that pretty spectacularly in recent years. In the property markets and the share markets, the returns most people have enjoyed in these asset classes in the last 5 to 10 years are well above long-term averages. And to be honest, or to be fair, well above what you should probably expect if you've got a sort of fair-minded view on these sorts of things. And that's the important point to understand with what's going on at the moment. We've all kind of enjoyed this wonderful free kick in the last few years. We've all kind of made money a little bit too easily. And with the return of inflation, that's what's got everyone so worried. You can see now, if we fast forward through the next 12 months, what has happened with inflation in these three economies. And we did these charts in January. What you can't see is that US inflation has kept going up higher still. It's just touched 8% last week. An 8% print for US inflation is terrifying. That's the highest reading in 40 years. If it was sustained, it would be devastating to the global economy because so much of what happens in the US drives what goes on in the rest of the world. Fortunately, it's very likely, famous last word, but very likely that inflation is going to start falling this year and next. And that's really the key debate that's been going on in the market for a little while now. How fast is inflation going to fall and how far is it going to fall? Because that's going to have a really big impact on what interest rates do. We do have some insights into this. The market prices everything. So you can see on these dotted lines here, the forward price of inflation. So what the market currently thinks inflation is going to do. And we can see that. It's quite interesting, actually. You can see what the market is pricing inflation to be by the different prices of bonds. If you buy a regular government bond or an inflation-backed government bond, the difference between those two securities is essentially the market price for inflation. And there's two things that I hopefully can stand out quite striking. Is one, that the market does think inflation is going to fall back. So hopefully this is not a disaster. But secondly, that it's going to settle at a much higher level than we had in the decade before the pandemic. Those two dynamics, how fast inflation is going to fall and where it settles, in my view at least, is going to drive what asset prices do for the next little while. Much more important than economic growth, much more important than which side of politics is in power in the next little while, because of its transmission mechanism on interest rates. And I'll give these two next little slides, so if we give a little example of why it's so important. So inflation has been building and building for about 12 to 18 months now, and most of last year, the market was very relaxed with what was happening with inflation. There was this concept out there that inflation would be transitory. Again, another term you probably heard bandied about in the press. The US Federal Reserve is adamant in saying, yes, we're seeing some inflation tick along, but it's nothing to worry about. It's going to be a transitory phenomenon. And if we fast forward, this is US interest rates up until June of last year, so the middle of last year. In June of last year, inflation in the US, biggest market in the world, was running at 5%, so 2.5 times what the Federal Reserve is mandated to keep it at. However, everyone in the market thought this is a very short-term thing, it's nothing to worry about. And again, you can see here what the market thought interest rates. Would you mind doing the forward curve?
Sure.
What the market's future thinking on interest rates would be. So you can see in June of last year, markets thought interest rates, inflation is very high, but interest rates are going to stay low for a very long time. This is nothing to worry about. Instead of that, what's happened is you've had this dramatic spike in short-term interest rates and this shift in market expectations where the market now thinks that interest rates are going to rise much more quickly in the near term. This might seem like sort of anodyne granular stuff, but it has real-world implications in financial markets. We've gone from thinking there wouldn't be any interest rate rises in the US this year to the market now pricing in 7. And that's a huge shift in big asset classes like equity markets and bond markets. And it's really the driver of what happened. If you remember, before Ukraine, we had a real hiccup in the markets. Markets really sold off in January of this year. And this shift in interest rate expectations is what was behind all of it. Now, why did interest rates shoot up like that? Why is the market suddenly thinking that interest rates are going to rise a lot quicker? Well, if we jump to the next chart, this shows US inflation until June of last year. I was saying 5% inflation, the Fed's out there saying this is nothing to worry about, it's transitory. And then you can see what the market thought inflation was going to do then. The market thought this is a very short-term spike, it's going to come back down very quickly. Unfortunately, inflation kept going up, quite dramatically so. And you'll now see expectations are that it falls slower and settles higher. And that's really the dynamic that's worrying everyone at the moment. And unfortunately, what's happening in Ukraine makes this dynamic much more acute. I don't think the market's really found its feet on this point yet, but going forward, the problem we face is, a central bank has two jobs: keep economic growth high and inflation low. And if economic growth is getting too low, you cut interest rates. If inflation is getting too high, you lift up interest rates. They're suddenly presented with, the backdrop that I just told you about on steroids. The war in Ukraine, the Russian invasion has sent commodity markets into the stratosphere. All of these inflation numbers I'm talking to you about now are pre the war in Ukraine. So the 8% print in the US does not include the impact we're going to see coming in petrol prices and food prices and all that kind of stuff. So we've got a guaranteed another leg up in inflation coming. At the same time, it's done a lot of damage to global growth. So we should expect growth to start slowing, particularly in Europe. The numbers I'm seeing in Europe now are looking pretty bleak. So if you're a central banker, you've got to keep economic growth up. So I guess, I should cut interest rates, but gosh, inflation's going even higher, so I'll lift interest rates. It's going to make that handoff, that job that they've got to do, very, very tricky. Now, I wish I could stand up here and tell you what's going to happen with inflation and interest rates. We'd all make a lot of money. Unfortunately, forecasting these things is a bit like forecasting the Australian weather. Even the smartest economists can only give you a very vague steer on what's going to happen. So more helpfully, we think, and it's certainly the way that we're positioning the portfolio and thinking about lives ourselves, is really just to prepare yourselves for two very likely outcomes and make sure your portfolio or your investments can weather both of those. The first is the optimistic scenario. So, whilst these numbers look very scary, and I get a lot of the commentators are sort of making comparisons to the 1970s and things like that, there are some really good fundamental reasons to think inflation is going to come back down again reasonably quickly over the year ahead. The pandemic and the way we dealt with the pandemic was really peculiar. We basically turned the global economy off, shoved a lot of money into everyone's pockets, then turned the global economy back on. So we've come out of what should be a recession all loaded up with cash, with interest rates super low, supply chains all in haywire because we've hit the stop-start switch. All of that stuff should start washing its way through the system throughout this year, and that's why the market is pricing that will do that. And so long as that's the way it pans out, so as long as inflation does start to fall down again reasonably quickly, yes, interest rates will go up, but in the context of things, if you can remember that slide before, some of you with longer memories, if interest rates settle at sort of 2%, there's hardly going to be a crisis for a market that is still incredibly cheap based on long-term history. So under the more optimistic scenario, I guess the way to think about life would be there's going to be a big headwind we have to work our way through. Inflation, interest rates, they're never good for asset price returns, stock markets. But we're probably not in store for negative returns, just it's going to be a lot less fun. The last few years it's been, share markets have kind of been on a wild ride. Looking ahead, maybe it's just more subdued. Investing is going to be less fun, but certainly not going to be a negative sort of environment. The second scenario is the scarier one, and this is the one that hopefully is not the most likely outcome, but the longer the war goes on, the more likely it becomes, I think. And that is, what happens if these high inflation numbers we're seeing don't start falling down, if they start to get baked into expectations. And as I was saying before, that the mechanism for that to happen, the thing to watch really or to worry about, is through wage expectations. It's all well and good telling the man on the street that, this inflation you're seeing is transitory and you don't need to worry about it. That doesn't change the fact he's taking a real 8% pay cut. And that real 8% pay cut is coming at a time of really low unemployment. It's also coming at a time when a big change in working practices after the pandemic. We're all out there finding our bliss now. A lot of people starting their own businesses or retiring early. There's a real shortage for workers out there. It's hard to force on that kind of cohort an 8% pay cut. The other thing too, just to say, the argument that this is transitory is wearing thin. We've been, not we, but I guess the economists, the people smarter than me, have been saying this is something that's going to disappear very quickly for over a year now, and they've been, quite spectacularly wrong. How inflation starts to become a problem is through expectations. The more people that start to go, bugger this, I'm worried about inflation, I want a pay rise, the more of us that do that, the more it becomes self-perpetuating and the more it kind of wills itself into existence. And why that second scenario is the scarier one, the one to kind of pause your breath on, is if we do start to see inflation get a little bit out of control, central banks have this mandate to keep a lid on it. They haven't had to worry about it for a very long time. If they do have to start worrying about it, it's going to mean interest rates much, much higher than what we've been talking about here. And historically speaking, that has a very nasty habit of ending in recession. And even if it doesn't end in recession, an interest rate regime where interest rates move much higher would mean a big derating for most higher risk asset classes, particularly the share market. If you remember back to my analogy of the seesaw, you push on one end, the other end goes up. We've been pushing down on interest rates for a decade now. Asset prices have had a real free kick. If that relationship starts to work the other way, then it's going to be a very unpleasant place to be an investor. I'm no better at any of you than forecasting the weather. If you put a gun to my head and asked me for probabilities, I'd say, personally, I still think the first scenario is the most likely one, but we can't discount the risk of the second one. And again, the longer the situation goes on, sadly, in Ukraine, I think the more plausible that becomes. Under either of those scenarios, we'd like to think GVF, as Emma was saying, would be a solid option for you to think about. Mainly because we make most of our returns regardless of what the market does. So we make most of our money through investors by finding cheap assets, rolling our sleeves up and unlocking the value in them. And that means we're pretty immune to whatever the market does. That said, if GVF doesn't make sense for you or doesn't make sense for you, I think the thing I'd sort of try and impart, or the thing to remember, is that if we are in store for a period of lower returns, so a little less fun in the markets, or indeed in store for a bigger pullback in the market, it has to be viewed in the context of this tremendous run we've had in recent years. Share markets do not compound at 20 to 30% into perpetuity. That's just not how they work. You need to have really good, grounded, reasonable expectations of what to expect from your portfolio. And I think the biggest risk that Emma and I see when we chat to investors is that expectations have really crept higher. If you're out there today wanting another 20 to 30% from your portfolio, you're possibly taking a lot more risk than you perhaps realise you are. So that's probably the little bit of wisdom I'd pass on.